Hello and welcome to the 5 Things You Need to Know podcast. I'm Chubby Jayaram Singh and I produce business and investment stories for Money Mind on CNA. In this episode, we are looking at the 5 things you need to know about China's electric vehicle market. Joining me now is Lim Chee-Kiang, China Managing Director of automotive consultancy Urban Science, and Jing, Director for Corporate Research at Fitch Ratings in Shanghai. Welcome to the show.
Thank you for having me here.
Hi Chubby, look forward to our chat.
The growth of the electric vehicle or EV market in China has been nothing short of electrifying. Across the globe, there are 7 million electric vehicles on the road, and almost half of those vehicles can be found in China. We also know that 99% of the world's electric buses are found in China. Jing, China has grown to become a huge market for electric vehicles with many brands and startups, and also a major manufacturer of electric vehicles.
Oh yes, with over 1 million EVs sold every year, China is by far the largest EV market around the world. But in terms of EV penetration, it's only around 5% of China's overall auto market. It is a market with huge growth potentials. So a lot of EV manufacturers, including many startups, emerged after China relaxed the entry barriers for EV manufacturing. But so far, for consumers, there are actually not many brands or models to choose from if we compare the EV market directly to the conventional car market. So I won't say China's EV market is a mature one already, and its competitive landscape is subject to further change in the future. If we talk about EV startups, China had hundreds of EV startups a few years ago, but less than a dozen have successfully launched EV models to the market. So some leading brands have ramped up deliveries and proved the market value of their brands and products, but many others are still under great pressure to get funding and struggling to bring out their first models. So this year, we actually observed a strong demand for high-end EVs by Tesla and some Chinese EV startups, especially in the high-end electric SUV segment. Startups such as NIO, Li Auto, S1, and WM are now ranked top in the best-selling models.
Let's think about why EV is important for China. That explains a lot of the motivation behind the government policy and the startup as well. One is the technological part of it. The automotive industry is a very big part of China's economy. It contributes to a significant part of the GDP and then even a bigger percentage to the jobs. So it is very strategic. But if you look at the history of the industry, China has been relying largely on imported technology from the Japanese, from the Germans, and the Americans. So it has always been a desire for China to find a niche to establish a global leadership. And EV presents China with the opportunity. The other part about the emergence of EV, I think you have to think about it from the whole digital disruption in China. It's well known that, say, online payment that is ubiquitous in China, and the way Chinese have taken to e-commerce shopping, for example, in a big way. It's the same trend, right? Whether it's a product or service, there is a high technology element to it, and EV fits the bill.
Chee-Kiang, you mentioned government policy, and that's second on our list. How important are government subsidies for the Chinese EV market? And could we see growth taper off if subsidies are rolled back?
The first 4 or 5 years of the EV market in China was sustained by government subsidy. This is to jumpstart the industry, but the government recognized that this is not sustainable in the long term. So it has been already announced years ago that the subsidies will be reduced over time. So the market is prepared for it. Secondly, with the greater adoption of EV, you do not need the subsidy. And also with more EV charging infrastructure, that hurdle will become less important in a potential EV buyer's mind. But the problem here is the removal of the subsidy has not kept up with the availability of choices and the price of the vehicle. So I would characterize this period as the no man land. It's a point where the EV's subsidy has gone down, but to a consumer, there is not many choices yet. You are only limited by Tesla and a couple of the EV startup. But very soon, many of the traditional car makers like Volkswagen, like GM, like Mercedes, like BMW have announced massive plans to launch EV towards the end of this year and starting next year. And by that time, the consumer will be spoiled for choice.
Well, I agree with Chee-Kiang. Government subsidies used to be one of the key drivers for China's EV sales when those EVs were extremely pricey. but it was not the only determinant. In large Chinese cities, a free EV license plate plays bigger roles in buyers' decision-making process. So also the weight of subsidies has declined as China cut the subsidies sharply in recent years, and these will be completely phased out after 2022. As the cost of battery keep going down, in the future, cost parity of EVs relative to fuel drive vehicles could be realized without subsidies. So industry consensus is that this could be materialized around 2025. Looking forward, the key drivers for Chinese EV market will be, firstly, a rapidly growing consumer market for EVs. This is comprised of both demand for high-end EVs in top-tier Chinese cities and also demand for cheap, low-end EVs from rural markets. Secondly, a recovery in EV demand from taxis and ride-hailing services. This segment used to comprise around 30% of China's EV demand in 2019. Yet was severely hit by the subsidy cuts and the COVID-19 outbreak. So we expect supportive central and local policies to restore demand from the operational fleets going forward. Finally, there will be more EV choices and EV supplies in the next 2 to 3 years because conventional global automakers will accelerate launch of their EV products. In particular, JV OEMs in China are under great pressure to ramp up EV production just to comply with China's stringent NEV credit requirements. So a wide range of EV choices with attractive features will come in the markets soon and will further boost consumer demand for EVs.
So rising consumer demand and subsidies have fueled growth in China's EV market. Now let's move on and talk about price. That's third on our list. Jing, you mentioned that there are 2 price points, one for the luxury market, and then you have the basic models. Overall, are Chinese EVs cheaper than foreign players in China like Tesla? And could this be a driver of growth for local EV manufacturers?
It's actually not fair to conclude Chinese EVs are cheap. The prices of the best-selling Chinese EVs range from 20,000 RMB to over 300,000 RMB, many depending on their market positioning. For example, NIO and Li Auto's large SUVs are more expensive than Tesla's Model 3, but they do offer good value for money if compared to similar-sized fuel-drive SUVs by traditional OEMs. Also, high-end Chinese EVs have already broken the previous price ceilings of Chinese proprietary brands. That's why many large Chinese auto groups also announced their plans to launch high-end EVs. So it will be a good opportunity for them to enhance their brand value.
China over the years have established a very mature automotive supply chain. So a lot of the parts are made in China. You have the efficiency in manufacturing and relatively lower labor costs. One of the issues in the Western car manufacturer is unionized labor. Because they're unionized, you got to pay them higher salary, plus they will go on strikes and so on. They will increase the cost. That's not an issue in China. From the total cost of the parts as well as the labor, China is still naturally cheaper when it comes to building a car. So that primarily is the reason, right? But of course, automotive industry is one where import tariffs plays a big part, right? So there are countries who will actually impose tariffs for importing a Chinese car, and that's still quite prevalent. It's a rather sensitive nationalistic political issue. So that would equalize the cost of the car when it's exported elsewhere. But if you just look at the pure manufacturing cost of the car, it is not surprising that Chinese-made EVs are cheaper. And cheaper does not mean that they're necessarily inferior in quality than design.
You're listening to the 5 Things You Need to Know podcast. And today we're talking about China's electric vehicle market. I've been speaking with Lim Chee-Kiang from Urban Science, a US-based automotive consultancy, and Jing, who is with Fitch Ratings in Shanghai. So far, we have looked at growth of EVs in China, how government subsidies have been fueling that growth. We also talked about the price and how made-in-China EVs may not be cheaper than some foreign brands. And now cruising over to point number 4. Jing, are China EVs profitable because it's a competitive landscape with foreign players, local startups, and fuel-drive vehicles?
Yes, I agree that the issue of the competitive landscape for EV startups is that they're competing not only with each other, they are also competing with conventional vehicles, fuel-drive vehicles.
If you just look at the pure cost of an EV, about a third or so of the cost of the EV is actually the battery. We have also seen that the battery prices have been going down significantly as more and more batteries are sold and more batteries are built. And with the scale, price will go down. So as a result, the cost of the EVs will go down. And if you can continue to maintain the price, that means you're going to be more profitable. And as more and more companies innovate in terms of new business models around services, these companies can get additional revenue stream. Something I haven't talked about is actually EV charging. Cars needs to be charged, and that is something where you can also offer a service. And there are many innovations around that. So I think profitability is not very far away because the market will always impose the discipline. And for EV companies who lag behind in terms of finding the right innovative business model, they will be punished by the market. For those who innovate, they will be rewarded handsomely by the market, and the rest of the competition will follow as well.
As Chee-Kiang was saying, for EV startups in the near term, volume and the brand value will be prioritized over profitability. So when the volume brings economy of scale, so that margins can improve with lower raw material costs and lower DNA cost per vehicle. But that would require large investments in branding and marketing at the first place. Also, EV startups need to keep up with the cutting-edge technologies, for example, the autonomous driving, and ensure their production capacity bottleneck is addressed smoothly. Therefore, their R&D and the capex will be substantially high in the near future. So turning profitable is possible, but that will require good cost control strategy and sustained volume growth to justify their heavy investments.
Right, and finally, Chee-Kiang and Jing, since we're talking about profitability, is turning overseas for growth one strategy that Chinese EV players need to think about, especially when penetration in China is still low and China presents a huge opportunity?
I would say it's not a priority at the moment. Going abroad could be a smart strategic move. Selling overseas could be a marketing strategy that helps to enhance their brand value in the Chinese market. They will also be able to sell some EVs overseas because there is demand. For example, European EV market is booming this year due to strong policy support. So Chinese EVs with attractive features and prices could appeal to some European buyers as well. But remember that European countries, in particular those with their own established auto manufacturing value chains, are more likely to grant support to their local manufacturers. Also, from the perspective of Chinese EV startups, most of them are still struggling to get sufficient funding and ramp up volumes in China. So they won't have spare money to invest in new capacity or aggressive marketing activities overseas.
If you look at some of the EV products that's from China, they're actually very, very high quality and well designed, and has a lot of innovative feature. They have dashboard, LCD screen that runs across the whole dashboard. They have voice assistants that allow you to command the car to open the window. You can actually use your voice to activate the non-driving function. Some of these innovations will easily be exportable to other markets as well. The quality of the product is ready. What might be the impediments of the importing country? There are two. One is the infrastructure, because many of these markets outside of China do not have the established EV charging infrastructure. And as a result, even if the consumer would like to buy a Chinese vehicle, they are not going to be able to find the necessary charging station to fuel the vehicle. That is one. And increasingly, because of the US-China tension, that might also become a damper for some of the EV makers, particularly if they want to export into China. But in terms of the product, in terms of the price point, I think they're ready. The Chinese EV products are generally cheaper than the Western equivalent like Tesla. They would naturally be competitive when they go to the Western market, for example. The reason why that might not happen as soon, these are due to other reasons than just the product itself.
Right, so going overseas is important but not a priority right now. With that, it's time to wrap up the podcast. Jing and Chee-Kiang, it has been a very insightful conversation. Thank you for joining me.
It's my pleasure.
Thanks for having me.
I've been speaking with Lim Chee-Kiang, China Managing Director of Automotive Consultancy Urban Science, and Jing Yang, Director for Corporate Research at Fitch Ratings in Shanghai. Thank you for joining me. Catch you again next time.